My name is Dylan Setzer. I'm with US Bank. Thanks for all of you for coming. A little bit about me. I've spent 6 years with US Bank, a little over 10 years in the business bank, in the banking space altogether. Been kind of all over the place: Ozaukee County, Milwaukee, Waukesha County. Recently, I'm in the commercial lending space, so financing owner-occupied and investment real estate. So happy to be here and happy to learn a little bit from these guys and hopefully some from all of you as well.
All right, I'll jump in. Jack Larson, so personal and commercial insurance broker. We're from Colonial Insurance Agency, so that's located in Menominee Falls. Deal with a lot of investors. I think we kind of ballpark somewhere around 5,000 units currently insured, anywhere from owner-occupied duplexes all the way to 3,000 units, depending on the owner. So, you know, commercial real estate is definitely a niche of ours, so we're excited to talk about it tonight.
Yeah, and just to tie on there, anything from like first house hack, duplex, anything like that, short-term Airbnb. We have a lot of different markets that we can reach out to that has an appetite for each. So yeah, happy to help with any questions.
Awesome. Well, I put together a little, I can go ahead and just jump right into this, if you don't mind. So I, in the left side of your folders, just put together a little PowerPoint for you guys. Just kind of outlining the things that US Bank does and the type of things that I might be able to help you or somebody you know with. Owner-occupied real estate lending, obviously that's something that we can do very well with. Longer terms, longer fixed rates. Industrial, manufacturing, industrial, whatever, office space, we can kind of handle just about everything. There are some areas that we don't do super well with. Things like the more higher risk gas stations, hotels, things of that nature. Doesn't mean we can't do them. It just means that there's a few more hurdles that we just have to go through in terms of environmentals, and your terms aren't as generous as other investment or owner-occupied commercial real estate. I know everyone here seems like investment, so that's what we'll go to here next. The investment real estate, you're looking to add to your portfolio, adding additional properties. If you're looking to refinance any properties, probably not necessary, given that if you didn't do that already, you kind of missed the bus. And I hope your rates aren't as high as they are now as they were previously. So I doubt that refinance is in your wheelhouse unless you're looking to take cash out, which there are a fair amount of real estate investors doing that right now. If you have a high performing property that has a lot of equity and you'd like to put it somewhere else, a cash out might be worth your while. There's a number of different angles that we can take. Every situation, every deal is different. They're never the same. So it's you can always look at it from different angles. In terms of trading up properties, that's something we can definitely help with. Generating passive income, of course, that's why most of us like investment real estate, right? Competitive and flexible terms, which we'll get into here next on the next page. Current rates I pulled this morning for all of you. Typically with investment real estate, we do a 3, 5, or 7-year term. This morning, 3-year term amortized over 25 years, 5.42. 5-year fixed term, 5.57 amortized over 25 again. And then the 7-year, which does have a little bit different underwriting guidelines, which I can tell you about here in a minute. 5.72 for the 7-year term, fixed for 7 years, amortized over 25. The 3 and 5-year term, typically a down payment of 20% is what is necessary for a 3 or 5-year for investment real estate. For the 7-year, we like to see 30. The 7-year is great if you're looking to lock that rate for the full 7 years. I will say though, we've seen a lot of investors not wanting to lock that long. There's some people that feel, no way, I'd rather do the three-year because I think rates are going to change and I don't want to be stuck with a 7-year term and potentially a hefty prepayment penalty if it's a sizable loan. So that's kind of the difference there. If you wanted to do a 1-year term, we could even go that low too. That's something that people wanted to do. We can work with you on that. In terms of the owner occupied, if it's an office space or industrial that's occupied by the borrower, that we can do 10, 15 years on, depending upon the property and the situation. Like I say, every deal is different. We kind of look at every single deal from a different perspective and try to find the best ways to make it work. Next here, in terms of like a deposit relationship, we have treasury management options, merchant services in terms of collecting your rents. Obviously, I met a property manager here today, and I know maybe some of you manage your own properties as well. But we have solutions that can make managing your properties easier in terms of maybe ACH, where you're pulling your payments from your tenants instead of collecting a check every month, or tenants paying you with Zelle electronically. Might be a little easier for you to collect. We have all those different solutions for you, along with we see a lot of fraud with landlords giving security deposits back. When you write your check out of your bank account to give your tenant their security deposit back, you're giving everything on that check, every bit of information of your banking. You're giving them your routing number, your account number, your business name, and there's a lot of check fraud going on right now. And so we have filters in place where you can go into our system and say, I wrote a check to Dylan Setzer for $1,000 for a security deposit. That's all that check can clear for, and this is the check number, to prevent miscellaneous washed out checks and things of that nature coming through your bank account, which is a total nightmare and something I don't think anybody wants to deal with. Next page just talks about making payments, which I will kind of talk about here. We do have business credit card options, which right now we have an offer for 0% for 20 months. A lot of people like that. We can look at doing lines of credit and things of that nature, but free money is always great. If you can get a really nice size credit limit, which is what we shoot for, of course. And if we can give you some free money for 20 months, that's always nice to make improvements or whatever your heart desires, I guess. And the last 2 pages on here, I have an offer out there. US Bank has an offer for $300 opening a business checking account. Talks about the criteria over to the right to do that. If that's something you're interested in, I'd be happy to help. Another thing is here, the next page is that 0% that I talked about in terms of the credit card offer. So that would be another option for you there. Lastly, on the other side of your folder, I have a multifamily market report that we pulled for you today. Interesting information. It kind of pulls in, I want it to be generic as possible to include all of the markets of Milwaukee, where that's, Horn and I were kind of talking about West Dallas a little while ago, or we can narrow that down. A lot of times we use reports like this if maybe we're trying to cash flow a deal and you're purchasing a property that maybe the rents are currently pretty low, maybe below what the market is paying. We can look at reports like this and say, well, this is really what this property could be getting in rents, and adjust our cash flow to that. So I think it's a nice resource for you as investors, and also really great resource for us as bankers to take a look at how properties perform in different areas. Like I say, if you go through, it talks about the vacancy rate, which in the Milwaukee market is super low right now. That's really something we've got going for us is opportunity there with our vacancies being so low. You'll see that on page 6, and it goes into page 7, which it goes into rents, but I won't bore you with all the information here, but when you have a minute, take a look. And if you want a more narrow report, say, Dylan, this area is a market that I'm really interested in purchasing in. Would you mind running one of these for me? And I'd be happy to do that for you. If you look on towards the back, it talks about new developments and things. But you'll see there's a breakdown on page 24. Ozaukee County, Washington, Waukesha, and then Milwaukee is broken up in a lot of different pieces because, well, Milwaukee is very different. You could go 2 blocks down and you're in a totally different type of neighborhood, which is really, I think, an exciting part about Milwaukee. That we got a lot of different things going on in here. So my card is in the folders. If you have any questions, be happy to have a phone call with you or email or get together for coffee. I'm all about that. You have any questions? Anybody?
How about you guys go on the insurance side? And I'll just do like a sort of.
Cool. Yeah, that sounds good.
Sure.
Sure. You just want like a general overview
Yeah, I think
of the
kind of
market?
where we're thinking you guys put the market.
Sure. Yeah, I mean, as we're talking about commercial real estate, the biggest thing right now is probably replacement cost as it relates to anything building material, inflationary. You know, I'll bring it back to like a single family home, for example. We used to underwrite at what, 180 a square foot for replacement cost. And now we have homes that are burning down and the cheapest bid our carriers can find, they're 250 to 280 a square foot. And that happened in 1 year's time, about 1.5 years time. So that replacement cost is probably the biggest thing that's happened to disrupt the insurance market. So good time to take a look at your policies if you have commercial policies and make sure that you're adequately protected. And I'll bring that back into the commercial space. Commercial insurance is looked at a little bit differently than personal insurance. So there's something that's called co-insurance. You want to be above 80% of what it costs to truly replace that. And if you haven't really adjusted your replacement cost on any of your policies over the last, call it 5-10 years, you might be underinsured. So if you're underinsured and you're under that 80% threshold, you could be risking financial loss in the case of any sort of claim. There's considered co-insurance penalties there. So long and short, just to try and bring it back together, it's really just the replacement costs that are kind of disrupting the market right now. Outside of that, you know, commercial property, you know, we do a lot in the habitational space, but there's a lot more investors like the Smart Asset team, for example, that are getting into the industrial space. You know, that stuff is staying a little bit more consistent and a little bit easier to quote and rate from an insurance perspective, but I'll turn it over to Dan.
Sure. I think another thing to just kind of watch for and be cognizant of is just your overall rate increases. I mean, I think we've all seen the weather this year up in Minneapolis. I think our insurance companies refer to the claims as cat claims. There's been 4 cats this year alone in Minnesota. So I think regardless, rates are going up no matter what company you're with. I would say if you're seeing increases above and beyond 10%, it's time to talk to your broker. Hopefully you're working with a broker so that they can be nimble and work with different carriers and really find a company that has a strong appetite for whatever you're investing in. You know, habitational used to be really popular across the board with all insurance companies, but some have just truly lost their shirt underwriting it lately. And I think the ones that they're not just going to bow out and say goodbye to all that premium, but they're going to take the 25, 30, 40% rate increases and just kind of pray that you stick with them. And then it's just money over the top for the carrier. And you also have to look on the flip side, the insurance companies, what they've been investing in the last probably 4 years, bonds, you know, really low interest rate environment things. They're not getting the returns that they typically do as well. So the next answer with higher reinsurance rates for them is to hit the markets that really haven't been performing well. The biggest suggestion that we have with all of the clients that we work with is to risk transfer as much as you can. That would be through requiring renter's insurance for all of your tenants, whether that be a commercial tenant in an industrial building or just residential tenants. I would say 90% of the claims that we see are not the investor's fault. You know, it's usually like an overloaded outlet within a unit that they were using a janky extension cord on that caused the fire, right? Or an industrial complex that wasn't following proper like HAZ code procedure, putting certain things in certain containers, and fire starts because of that. So there's a lot of language that you can include to protect yourself and just pass that risk off of you back onto the tenant, because at the end of the day, they're the ones that are operating that building every day. So very broad stroke, but happy to help with other questions too.
Yeah.
I would just say, like, on a personal note, like the replacement cost issue really hit home for me because we had a water leak in one of our buildings in River West. The tenants had stoppered the sink and left for a week's vacation, and we found out that the water had overflowed. And the unit that we just renovated below, it's like, hey, we're seeing water from the ceiling. And when we investigated, we found out this whole debacle, and we realized very quickly that having the proper insurance was very impactful for us as far as like what we were getting back from the insurance company. And I would recommend everybody make sure that they look at their policies to make sure that you're getting actual replacement costs, because the insurance companies will give you, a certain amount of money for damages per square foot for, whatever their logarithm is. But, it actually may cost you a lot more out of pocket. Like you were saying, the actual cost is much more. And, what you want to do is insure yourself against that cost, because that's ultimately what you're going to be paying, especially if you have total loss of the building. Say you buy a duplex for $200,000. Well, in a up and coming area, the replacement cost of that today with the cost of wood and materials and labor could be upwards of 250, 300, and then you're going to be net negative, whatever that amount is. So I think it's really important to make sure that you have the proper insurance, because that really hit home for me in my portfolio just this year. And I also echo that same sentiment about the renters insurance. We have all of our renters are supposed to have renters insurance, because ultimately, that's kind of like the first line of protection. Part of that damage was actually covered by our tenants insurance plan, which was fortuitous, because we actually ended up having to make a claim, get a claim adjuster involved to actually recoup the full amount of the damages that we had. And it wasn't without a lot of kicking and scratching that we got the insurance company to cover that. But had we had the proper coverage, I think it would have been a lot less here.
Right. And that's a
really, really good points. Really good points.
Yeah, great example, like claim 101 right there too. And it's okay to like be an investor, and when you're first starting out, maybe you're buying that property that needs a little TLC, and maybe you just want to invest it for your cash value for that year. And then once you turn a unit, flip it over and get it to the proper amount. But I think we get on autopilot a lot, or some of our clients get on autopilot where it's like, oh yeah, just leave it as is. And you tell them like, well, this is what we're seeing right now when claims are paid out. We're trying to protect you against that unexpected repair bill and how much they would have to come out of pocket for that.
Did you guys determine that you had the right insurance coverage? Your dwelling limit was high enough?
We didn't, but once we got the insurance claim adjuster to kind of fight for us, we ended up getting the money from our tenants insurer.
Perfect.
Nice.
Yeah.
We ultimately determined that it was their fault, like for stoppering the drain. There was there's specific language, it got a little tough, but there was specific language that the insurer was asking about to make sure that it wasn't, it's kind of like medicine where there was like a pre-existing condition. They were trying to get us to admit that there was like a problem, before, this is what it was. They said that if the faucet wasn't dripping, like leaky, then this would not have happened, so they denied the claim initially. But we went back and said that, well, the tenant never told us about the leaky faucets, so how were we to know to fix it? Ultimately, stoppering the sink drain had nothing to do with us getting our claim coverage. It was more fighting over a dripping faucet, which seems so asinine, but truly that was the crux of the issue. And once we were able to say, well, they never told us about it, then we were able to forward the claim. But I mean, I think that like, hiring the claim adjuster to fight for us really helped, kind of move things along too, because I spent many hours on the phone with insurance and it was frustrating beyond all belief. So that's something I would also recommend. Like if you have a claim, make sure you're getting the right representation to talk to the insurance companies, because you might not understand it as well as they are, especially when you're talking about big repairs. It was impactful. I mean, that was like a $20,000 repair.
Mm-hmm.
It's the whole floor, the wall.
After you had just done,
floor.
you had just flipped the unit below, right?
We had just flipped the unit below.
Wow.
Yeah.
It's unfortunate timing.
Yeah.
So you knew exactly how much this was gonna cost as the water was coming through.
Well, fortunately, there was another piece to this is, we had First On Site come and remediate it, and they were excellent as far as, coming there, documenting, because not only are they like remediation specialists, but they also documented everything we needed to submit to the insurance company as far as, what they had to do, how much damage there was, what was affected. And I mean, it was very helpful, combination of getting the right professionals involved and, having an advocate for yourself was really important.
Nice. Yeah, absolutely.
Have you guys seen that the cost of insuring a duplex, because that's the majority of my portfolio right now, has gone up? Like I'm finding that it's like harder and harder to insure these properties. It seems like a lot of carriers, for this reason, the cost of repairing things are going up. And, as you get like fires and other water damage, things like that, like they're just on the hook more often. It seems like they're not wanting to insure these properties as much as they were in the past. Are you guys finding that?
I would say with our markets, no. I think finding, without giving names of the companies specifically, out of respect to everyone we represent, but I think if you could find the smaller mutual companies that, their appetite is going to be more to that 1 to 4 unit portfolio. And if it's a heavy investor into 1 to 4s, like that's their bread and butter. They know how to underwrite it and price it and keep it stable. I think the ones that you may be finding that are not as competitive there are probably looking to get more in the space of the 16, 24 units and above. That could be part of it.
Yeah, and some of our carriers, I mean, they won't even go above 1.1 million. One specifically, and they're perfect for duplexes.
Yeah.
They love duplexes. That's their bread and butter.
Like 2% increases on renewals, if that. Like there's years that they're just flat across the board on portfolios. So yeah, I think it's more
company
just
by company.
appetite.
Yeah.
Okay.
Yeah.
Yeah.
Where other carriers won't touch anything under a 4 unit.
Yeah.
So it's truly depends on the carrier, and then, having an agent that knows what you're trying to accomplish too. And that has access to those markets.
Dylan, I had a question for you. So you talked about, and thank you for bringing this packet of information. This is great stuff.
Absolutely.
I know we've talked offline, but could you also, I think like one of the things I saw in this packet that that you could probably speak to was you guys offer additional financing services beyond this. For instance, if you're doing, it's not bridge lending, but it's like if you're doing construction on a property, you guys are able to, as long as you provide the right documentation, you're able to finance those repairs like up to like 80/20. Could you maybe speak to that? Because I think that, as investors, oftentimes we talk about value add, and oftentimes we often don't want to come out of pocket for all expenses. So if we were able to wrap that up with our debt service, that may help us to continue to scale or use that money in other ways. Can you speak to that a little bit?
Absolutely, yeah. I mean, I think it would be probably fair to say that a lot of investors don't want to tie up all of their cash into one specific property or even a small portion of their portfolio. This has been something that's been pretty popular in Milwaukee is people buying properties and then wanting to put substantial improvements into them, to make them more valuable, get better rents. We will, we're in that 80% range, like I said. So if you were to buy a property, we would like to finance 80% of its purchase price, making sure it appraises properly. But with improvements, we will assist you in reimbursing those up to 80% as well. So you buy a property for $100,000, put another 100 into it. We will finance 80% of your all in. With that, we need to show that you actually paid the money for it. We need to see that you paid a contractor for a new roof. We need to see that you did basement work or you put a brand new kitchen in it. We need proof that you did those things, but it is something we do. A lot of people will come out of hard money deals. They will use hard money to purchase for family, and it needs a lot of work. They'll use their own assets or even more hard money to finance their improvements. And when they're done with that property, they don't want to just say, okay, well, that's it. My 4 unit, that's my property, and I'm happy with all my money tied into it. Most people aren't that way, and so we're happy to assist with the improvements after the hard money deal is done and you've made your improvements. It's a good time to get your money back so you can increase your liquidity, and also maybe look for something else to increase your portfolio.
So if I had a duplex that I was going to buy and I knew that I had to put in $50,000 of repairs to get it up to snuff, would that be something that I would bring to you up front and then there would be like a draw? Or like how does that work with
There are ways to do that. Usually the process with draws isn't ideal. A lot of times we'll try to figure out other ways to finance that. Being a full service bank, there's a lot of different things we can do. We can look at assisting you through the branch with a home equity line of credit or a personal line of credit to give you that access for your improvements as a short-term vehicle to get the property up to snuff. So there's a number of different ways we can look at it, depending upon the scale of the project. We like to use caution there too, because we still need the property to appraise. It needs to appraise. That's step number one, is it needs to be worth your purchase price plus your improvements. And then after that, then we can pay you back 80% of your purchase price plus your improvements.
So does that, that's something like you work out like on the front end as far as like the appraisal? Like, well, it sounds like what I'm hearing from you is that you need to make sure that like the property appraises for a certain value, and that also there's some forced appreciation that happens there that you guys are willing to accept the lend on. How does that work exactly? do you work with appraisers to navigate those waters? Like, how does that work exactly?
I haven't done that yet. The majority, truly most of the deals that I've done so far have been people putting their own cash into properties to improvement or using hard money. So those are really the experiences I've had so far, would be people using their own money and just not liking the idea of their cash being tied up, or borrowing it from somewhere else to finance those improvements, and they don't want it sitting on personal lines or loans. So that's mainly what I've seen. It is, I will say, harder to get a deal done where we're saying, you know, it's worth X amount of dollars now, but once we're done with it, it's going to be worth this amount of money, because there's so many variables and so many things that could change between now and then that, you know, you as the investor, just making sure that you don't get yourself in a bind, because we're not upfront promising you that we're going to pay you back 80% of what you put into it. We're just saying that that is an option as long as it appraises properly.
Yeah. Obviously that differs between like residential and commercial, correct? Like commercial will be based off the after appraisal income, and residential will be based off of comps like traditional.
Right. Yeah. So in terms of the appraisals, we've been everything has, I personally have been not having issues with appraisals recently, which is good for the borrower. But I would say over the last, I mean, previously, it was hard in the appraisal space because there weren't, the comps weren't available, that the values were hard to prove because they're just, things weren't catching up fast enough to with the heat of the market, if you will. So the appraisal is something we typically don't run into an issue. And a lot of times we'll do an exterior appraisal, so we don't need to bother your tenants. You know, we can just get the facts of your building and share that information with our appraiser. They can pull their comps and do square footage comparisons and how many units you have in the building, or if it's a industrial space, you know, what are the comparables to that industrial space?
Really got you in a hot seat.
Like a little bit off topic, but do you feel like the environment for lending and insuring hotels and motels will change kind of post-COVID, or do you think it's going to remain basically impossible to get financing and affordable insurance on hotels and motels?
Yeah, I can start with that one. So I should state that that's not something that we have a super appetite for. Doesn't mean that other lenders don't have an appetite for that. It's just not something that I personally feel that we do all that well. So could it get better? Yes. Could it get worse? I don't know. But our underwriting standards have not changed. Initially during the pandemic, we did do kind of a freeze just to kind of assess the situation of what was all going on. But we are back to normal. Our underwriting standards are the same as they were. We haven't changed the way we do things because of the pandemic. Obviously, as I mentioned earlier, no deal is the same. So, you know, we do take into account different factors, because the pandemic was very much a part of all of our lives, and there are good things that happen and bad things. So if we can tell the story, that helps us out. But I guess the bottom line is our standards haven't changed. They're the same as they were.
Just as a follow-up, then, are you saying that, like, if you're looking at P&Ls, for example, you're considering the fact that there's been COVID for 2 years?
Right. Yeah. So if we can,
factoring that into the.
yeah. So if you have, you know, 3 years of financials, and you can show us that, look at in 18 and 19, you know, we were really doing well. Obviously there's a decline here because of COVID, but look at my 21, we're right back at it. That's obviously easy to explain. We can say, well, doesn't take a genius to understand why there was a dip in those years. As long as we have the historical, the more we can go back, the better. Typically, we look at 2 years. A lot of people are, maybe 2020 wasn't so great, but 21 is looking good. That's helpful, but it is something that's taken into consideration.
On the insurance side, we love hotels. I would say your franchisable entities like your Super 8s or Best Western, things like that, all day long, you shouldn't have any issue getting affordable insurance, just assuming that, you're gonna have proper loss control, like exit signs, and maybe during those down years, you took time to really spruce up interiors and make it look as nice as possible. The smaller motels can always be a little bit more interesting. I think as long as your mechanicals, roof, and interiors have been modernized, so to speak, I think those are still okay. We typically run into hangups with like electrical at a lot of those that may have been built in the 40s, 50s, 60s. Fuses, stab lock panels, Federal Pacific panels are really common in old motels, and those can be super costly to update. But we're actually bringing on a new carrier here soon that there's one company specifically in Wisconsin that was very, very heavy in hospitality and hotel motel, which is getting out of the space entirely. So we kind of adapted. We got one that writes them all day long. So yeah.
You guys have any,
Oh, we got one in the back. Oh.
So I'm looking at your report from the sales.
Mhm.
And looks like there was a huge spike in sales from, because we're on page 31, 32. Looking at the overall sales and then broken down by 4 and 5-star and 3-star sales. Like it says last year there were 166 deals, $473 million worth, whereas 2020 was 190 million, 2019 was 263 million, 209 million, blah, blah, blah. So it looks like it was kind of steadily climbing from like 2012 on, and then it went crazy last year. What do you account for that? And what are you seeing this year, year to date? I guess, what do you think happened?
Yeah, my personal opinion is that the rate environment, I mean, I kind of shared with you where we're at with rates. I mean, 1 year ago from now, we were writing loans in the high 2s, and now we're almost to 6% now. So when you take into consider what your monthly payment is and your total return, that's, I think a lot of investors and a lot of people decided, what a great time to maybe add to my portfolio with financing being so inexpensive. Historically, if you really look back a long way, rates in the 5 to 6 range aren't bad at all. We just got really kind of spoiled in the last couple years with the cost of money just plummeting. And to go to your second part of that, it hasn't deterred a lot. There are some people that have maybe slowed down their search in adding to their portfolio, but it's not completely out of mind. It's just more of waiting for the perfect property, whereas maybe a year and a half ago, people were like, what an awesome time to borrow some money. So let's do it. I think that would be my personal opinion what happened there.
So what does your crystal ball tell you about the next 3 to 6 months with rates? I know everybody's trying to guess this, but what's your crystal ball tell you?
It's hard to say. Our rates kind of jumped up quite a bit higher than a lot of other lenders. And I think now that the situation is somewhat settling a little bit more, I think our rates have been a little bit more predictable. I'm not checking them every day, like, oh my gosh, how much higher did they go today? Where now they're really holding steady. I would say for the last few weeks, checking the rates every morning, I would say that they've even gone down a couple times. In the next, my personal opinion is I don't know how much higher they can go so quickly in such a short amount of time. I feel like that could get dangerous in terms of, you know, there's the rumors and conversation of a recession, whether that'll happen or not. You know, who knows, that could be anybody's guess, but I think raising rates too high, too quick could definitely trigger something like that. And as I say, that is my personal opinion.
I got a question on insurance stuff. So last year, the year before, insurance rates jumped up a ton, right? What is do you recommend if, you know, how often do you see if someone were to come and say, hey, my insurance went off, we check and see if there's lower options out there? Is it generally across the board pretty close, or how often are you able to find like lower rates for the same sort of coverage?
Yeah, I mean, on the commercial space, it pays to work with a broker in that sense, right? You know, there's nothing wrong with working with captive agents. However, they're captive for a reason. They only have one option for you. So as long as you're working with a broker, they should have other options for you. But also, to play devil's advocate to that, I mean, they're going to place you with the most competitive market on the get-go. Brock, I know you and I have worked together in the past, and you know, we've had wide spreads on certain quotes. You know, sometimes $10,000 different because, quite frankly, one carrier may like that type of an investment and other might see more risk in it. You know, it never hurts to ask to shop it around, but you also want to remember, you know, there is such a thing as building equity with an insurance company. You know, you won't get penalized per se, but you might not get, you know, the best rates going forward if you're jumping around every single year. Right. So there's something to be said about building equity with that insurance carrier. And there's things that we can do to review coverages for you too, and see if we could reduce premiums in that regard, potentially ask underwriters for credit, depending on the carrier. But it's definitely something that your agent should be doing with you on a yearly basis. If they're not, and they're ignoring your renewals and you don't get a message from that individual for 5 years, you know, you might not be their top priority, unfortunately. So find somebody that's going to work with you and go to bat for you. And if it does come time to shop it around, we talked about some carriers that took 25% rate increases over the last year. If you see that, hopefully your agent sees that too, and they're going to proactively shop you around and at least have that conversation.
Okay, that nailed it. I mean, the agents, brokers, they're aware of the filings that the insurance companies are implementing for each line of business throughout the year. So really, you should never be surprised at renewal time with a, hey, 30% increase, this is our best offer, I got nothing for you. Well, that if you get that conversation, it's time to find someone that, hey, 30% increase at renewal, here's our next best option. Let's talk it through.
So what is the equity that you're speaking of? Like, how would you express that in service or?
Sure. Yeah, that's a really good question. So I would say for some of our investors that, you know, maybe aren't on that replacement cost spectrum of insuring things, they just want to do actual cash value and they've got the infrastructure in place. They PM their own properties, they renovate all their units, they buy all the material, they can absorb maybe a 20% co-insurance penalty on a claim. Those are the ones that if you've been with the company for 10 years and you have a $100,000 claim, I can almost promise you the depreciation is going to be pretty nominal because they see the value in you. Or if there's a gray area, like your insurance is your defense cost too. If a tenant sues you, if there's something that's really, you know, out of the ordinary from like a slip and fall or something like that, they're gonna go the extra mile to make sure that none of your assets get touched. So I think those would be two.
And for future investments too.
Yeah,
You know, the longer you stay with a certain carrier and the more you build a portfolio with that carrier, they want your business. You know, if you're paying $100,000 in insurance for your investments, well, you might get a better rate because they've seen how you operate your properties. They know that you're acquiring that renter's insurance. And, you know, the reality is commercial insurance, there's some wiggle room, right? And the carriers know who they want to work with. And if they know your track record, they're more likely to give you a better rate down the line too.
Do you think you could use that as a bargaining chip for your rates? When you talk with like an insurance company, like say like, hey, like, you know, I have a portfolio of duplexes and my renters, I require them to have renters insurance. Does that impact their underwriting or like the rate that you could potentially get in all? Is that just like, that's well and good, but it's still gonna be this rate?
I think the renter's insurance is becoming more and more like this is common operating procedure that they like to see implemented just because of the risk transfer. It benefits them too greatly. But I think if you can show copy your lease and some of your operating procedures and kind of tie that all into a presentation. We had one client that came out to a really good insurance company that's right by the Pfizer in Milwaukee. And he met with the CEO and said, this is my portfolio of my rental properties. This is how we operate. This is what they all looked like before, after, and what they're going to look like later on. I think if you can sell yourself directly to a company like that, you're going to get probably some benefit.
Yeah.
Yeah.
Mhm.
Yeah, and definitely, you know, it's something that your agent can take to the underwriters. You know, we submit quotes and then we go have a conversation with that underwriter. So the more ammo we have on how you're transferring that risk and using that renter's insurance to, you know, mitigate the chances of you having to file a claim. Yeah, it's taken into consideration. They might add more credit to the account and say that, you know, it's less risk because it is.
Do you have any advice for the investor?
Raising my hand. I know, like, raising my hand and jump over. Can I get a question? Or- Thank you, thank you.
This guy had a glass of wine.
I have a question for Jill. So back to your stats,
Yeah.
page 25. So the submarket inventory, top of page 25, are these like legit, like hard numbers? This is how many buildings, this is how many? This is really.
Yeah, it's a CoStar data. Yeah, so I mean, I can't,
Pretty close.
yeah, I can't promise how like,
Yeah, because I live in, I guess
Extremely
it would be northern Ozaki County, and there's only 798 rental units. It's not a lot.
right. I will say that there is a lot of, in terms of development, there are lots and lots of developments happening, which you'll see in here too, that people are seeing that there is a need for more housing, specifically apartments. And so there are people that are working to find a solution for that in terms of building. So maybe that's an opportunity for you. Maybe you need to build an apartment complex in northern Osaka County.
Literally. So southern Milwaukee County has 17,418 units. That's the #1 place in Milwaukee.
Mhm.
I would not have thought that. What's going on in southern Milwaukee County? Oak Creek, South Milwaukee, Franklin?
Yeah, I guess maybe,
Building 450 units. Yeah, Lakeshore Conference, Lakeshore Conference.
17,000. That's a lot. Okay.
I mean, I guess if you think of the south side, I mean, just south of Milwaukee, I mean, that's a lot of multi-unit housing too. I mean, that's not you're not gonna run into a ton of single family.
Sure.
You know, there's a lot of duplexes for 3, 4 and up.
Yeah. And then
Units.
North Shore, there's 5 buildings, 688 units? Is that like what, like Whitefish Bay, this area kind of?
Yeah, so I think that covers up into Fox Point and Bayside.
Buildings.
Yeah. Well, and yeah, that does not
So if
include
you get one
Brown
of
Deer.
those, you're pretty lucky.
Yeah,
Right, yeah, I actually,
So it's all those units on Fort Washington, just
Right.
north of here. like,
Yes.
yeah,
which and who knows if those are gonna hang around, right? Yeah.
Four major complexes, one of them just burned down.
Oh, geez.
Oh, yeah, they're rebuilding that one, yeah. Yeah. But it's kind of funny, when I run these reports, I also do it to find who are owners of properties, and when I typed in 53217, I think 3 landlords came up for me. Lots of, I mean, yeah, do you know what I mean? Like, it's just not an area where there's tons of investment real estate. Where if you dabble into surrounding areas, you're gonna find a lot more multi-unit housing versus single family. Yeah, the east side too. I'm not sure which side that falls into too, but that would be another area where there's lots of duplexes, lots of multi-unit buildings.
Also an insurance question. So I guess I've been a little bit lazy on our insurance front in terms of, we get a new building, let's just add it to our policy, add it to the policy, let's just add it to the policy, and it's kind of rinse and repeat.
sure.
Do you recommend that, or I mean, is it better to shop a whole portfolio, or is an underwriter really looking at every individual building and then giving kind of a general bulk discount?
Yeah, that's a very good question from not only a liability standpoint, right? As far as, how many, are they all habitational or?
They're a lot of mixed use.
Okay, yeah, so I tend to suggest when it comes to like apartments, per LLC would be no more than 10 buildings,
Okay.
specific buildings, or 100 units, whatever comes first.
Yeah.
And then once you hit that threshold, maybe time to create a new LLC.
Yeah.
And then if you put them all with the same company, you're still gonna get, preferred pricing because they're looking you as the individual still.
Yeah.
Like, this is how much you have with us as a whole. And I think that also insulates you from, if you have that one portfolio policy with everything on it, those can get kind of slippery quickly. If you have 2 large claims and then all of a sudden they tack on a 20% surcharge, they're probably not just surcharging that one building, it's across the whole portfolio. So your problem child that might have the claim, we usually suggest maybe we spin that off on its own policy and let that be surcharged on its own.
I
And
can do
then,
that.
yeah.
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 I know what that one is.
yeah,
Saw the rate increase with the rest of the buildings.
Yeah.
yeah,
I'd
But
actually have to do that on the duplex, so we had
Yeah.
the water damage, because I know our premium went up, and I was like, oh yeah, surprise, surprise. So
Yeah.
maybe we'll just spin that one off.
yeah,
right.
yeah, it's kind of a double-edged sword, right? If you take your whole portfolio and shop it, carrier is going to be more prone to give a better discount on those rates because they're getting more premium and they're controlling more of the portfolio.
Mhm.
But also if something happens and you have everything on one policy, yeah, I mean, you stand a chance of seeing those rate increases across the board.
Right.
So,
Knock on wood right now that we don't have to plan any of those.
Yeah.
We'll probably be in trouble.
Yeah. Yeah,
and that depends on the carrier too. Not all carriers are going to surcharge the whole policy, but some will.
mhm. And I mean, this is like any type of business, whether it be banking or, who your real estate agent is when it comes to buying things. A lot of it is on trust too. So like if you really trust your broker, they do a lot of mixed use investing, space insurance, industrial, whatever anyone is into. At the end of the day, if they come back with like 3 or 4 companies and just say like, these properties are all kind of the same footprint and vibe as far as tenant mix, keep them here. I would suggest these are all kind of the same, put these here. There's a lot of trust that you just have to take in your broker too. And just fitting you with the company that makes sense per building.
Yeah, something else too, I'll just jump in. Another way to mitigate potential loss, take a look at your policy and pay attention to what your actual, like your rental reimbursement would look like. You know, some policies come baseline with no rental reimbursement, and that's in the case of a loss. If you have a claim, let's say half your building burns down, you're not getting rental income from a couple of the units. Some policies come baseline with nothing. Others come baseline with 12 months actual loss sustained. In other policies, it could be a dollar figure. If you can, you know, figure out your risk tolerance, and then really figure out, if I have a claim, how long can I sustain this? How long do I really need to get this extra rental income? Is it 4 months? Is it 6 months? Is it 12 months? And then determine that from there. But a lot of our investors like that 12-month period. We've seen some pretty big claims that take 10, 12 months to fully repair. And you don't want to be out of that rental income, because then you're coming out of pocket to pay the mortgage potentially.
That was a really good one. We're gonna start nerding out on you with like all these optional coverages here now.
Can you, does that apply to like commercial? Because I've started investing in short-term rentals, and I have a commercial policy for that. So I understand that it has like different coverage. Would that be important to have, you know, in case I have like some sort of, you know, issue with the property, say like there's a fire and like I couldn't operate, you know, for like the month of July, which is like my highest,
You bet.
you know, season.
Yeah. Yep. So if it's on,
Would I just like go to my broker and say like, hey, like I want to investigate this?
Yeah,
like, can we add this
just-
to the policy where like if I was to like lose revenue.
so business income coverage is what you would want to ask him
business
about.
income coverage.
And you can dial your threshold. I think there's even percentages where it steps up for your peak seasons. So maybe just let them know what your peak seasons are. And then it's rated off of your annual gross receipts. And then most companies will offer like an extra 25% to hedge for the peak season. So it's a super affordable coverage too. Especially on like an Airbnb policy. I'd be surprised if it was more than what, $150 a year,
Yeah.
probably less.
So it's not like jumping up from like term, which.
No, which by the way, we don't do,
40 months an hour.
yeah, we don't do any life insurance for, well, we do small term stuff for people that understand why. We're not investment people, so. Another one that Jack kind of triggered my brain into, and Dylan as well, with the check fraud. If you're an owner manager, so if you're PMing all of your own units or investments, right now cyber liability would be one that I would strongly suggest adding to either your business owner policy, what is actually insuring the properties if you're a self-manager, or if you have your own property management company, it should go onto the property management policy. So us as landlords, we're all responsible to take care of our residents' information, banking info, anything that's on that lease. If that were to get compromised and, you know, their bank stuff gets compromised and it's found out that you're the reason, you're the one that caused the breach, that comes back to you. So we, like you said, with the check fraud, we have seen a ton of that. Yeah, that's a very.
Have you
important-
found that a lot of people have been on the hook for situations like that, or were they
A lot of
kind
it's,
of covered properly?
yeah, a lot of it's been awkward in the sense of like the check fraud, where maybe a check is stolen from a mailbox. We've had a lot of those, because like you said, everything is on that check. We've had it where, you know, $100,000 check for a service that a construction entity of ours did. Check never gets there in the mail, stolen out of the mailbox, and now it's a bank issue. So you're working through, you know, huge banks trying to prove a fraud case that you never received or deposited those funds. And in the meantime, you're waiting to get that
Money back.
money back.
Mhm.
So that is a nightmare.
Yeah, definitely if you're managing yourself.
Yeah. That one, along with, if you want to jot down, it's called EPLI coverage. Same for the owner operator. That would be if you're managing, that's your discrimination, whether it's against sex, race, harassment, anything like that. If a resident were to come to you and say, I think this is why you didn't approve my lease, or I think this is, you entered my unit and it's something weird. It's just a really litigious environment right now. And these are all very inexpensive add-on coverages that just really round you out.
Yeah, make sure your liability coverages are high enough too. Met some people here that are owner occupying a duplex. You know, at that point, that's highly likely that that's under a conventional mortgage, meaning that it's in your name. So protect yourself, have high enough liability coverage on those, because you're not the only person living in that house. And a lot of the business owner policies that we write come pretty standard with, you know, $1 million liability limits, but you definitely don't want to be too low on the rental properties.
I got a question about, you know, speaking about different portfolios. So would you, being a broker, be able to, I guess, suggest like, hey, you have these multi-families, we should go with this. You have these industrial, we should go over here. Is that what you're kind of talking about?
Correct. Yeah. Yeah, we can do policies that may blend industrial with habitational, but the risk and exposure for the insurance company and you and the investor is so unique and different from one another that you're really best finding the carrier that says, we love habitational apartments all day long, let's keep this guy happy. And then on the flip side, we're gonna go and find that industrial carrier that's their wheelhouse too.
And if you work with a broker, they're gonna know, you know, generally what's gonna be the best fit. They'll still quote you multiple companies, but yeah, definitely finding the right niche per carrier is important.
Yeah, habitational is hard right now. I mean, we do a lot of it, so we always keep a good pulse on it, but there are a lot of companies that are truthfully just saying we want no part of it, or we only want part in buildings that were built after 1990, or putting age requirements on things. So it is going to be a very volatile market probably for the next 5 years.
For what it's worth, I found that like an old downtown mixed use building with a restaurant is like impossible to insure. It's like the most expensive
Yeah,
thing we have, and it's almost like, I mean, granted, we can pass on some of that expense to the commercial tenant,
sure.
but even still, for a time, we're not gonna have a commercial tenant, but we still need to insure it, and it's astronomical, largely because the building is old. But when you're in the Midwest or not in LA or whatever,
Right.
you know, buildings are old here.
Yeah.
So it's more just a comment than a question, but it's like very shocking to me.
Mm-hmm. Yeah, that's a very good point. And that's where, again, hopefully your broker is going out and making that thing look as sexy as possible, and then how the
Yeah.
restaurant is using all the UL hood suppression systems and loss control. And there's always going to be a carrier to fit that need. We love those.
Any questions? All right, Elise, yes.
Yeah, thank you very much.
Yeah, likewise.